Hi everyone, welcome back to Be Rich. It's me, Vinod, alone again. It was fun having Anand with me on the table talking about big tech and growth stocks. And Anand said it very well and very eloquently that right now, looking at the way the market is, how things are so overvalued, it really doesn't make sense. Yes, a company might be great, but if you don't buy it at the right price, it doesn't make sense as an investment. So that said, for day one, we spoke about safe havens, we spoke about gold, then we spoke about big tech. So we covered the barbells. Now let's dive into the finance sector, insurance, and then we will touch upon a pharma, which you guys asked me about, French pharma, which has an Indian, what you call subsidiary here. And we'll compare that. And then finally round up with the Nasdaq 100 ETF. Should you be investing in the Nasdaq ETF right now? And that should conclude the video. There are a lot of questions you guys have asked from day one, day two, and I'm sure this video will also have a lot of questions. I plan to combine all of them and spread the answers over Saturday and Sunday, since if I do this, the video will turn out too long, and I do understand my editors are complaining, and I'm sure you as viewers also find it tiring to watch a 20-minute monologue from me. At least with Anand, there's a discussion of a back and forth, a break in the monologue, but when it's just me, I tend to rattle on a little bit. So I can understand. So that's why I decided to combine all the questions they've asked, which is quite a few of them, over Saturday and Sunday. So don't worry, I've not forgotten. It has not moved away from the format of taking your comments and answering them. It's just that I want to combine it and put it together at the end of the week, Saturday and Sunday, where we can also leisurely digest all that. And the people who don't want to watch the comment videos can skip those videos altogether. Anyway, talking about financial stocks, do they matter? Should we be investing in it? Of course. Let's get straight into it. Finance matters. Finance, like I said, gold is the backbone of defensive investing. Finances, companies, banks, and fintech, or all these guys are the ones who are holding our whole ecosystem up. Because without the flow of money, none of this is possible. Yes, that may generate a lot of hatred towards banks, but I don't know if it's warranted, because end of the day, you do require banks, because banks are the ones who enable any form of capital market to survive. I would say any market to survive. Even if you believe in a socialistic market, you need finance institutions like banks to help you move things along. So that said, do remember, like I said, in any economy, you need banks. Be it a good economy or a bad economy, you need banking, you need insurance, you need payment systems. Like I said, they keep the engine running. But they are cyclical in nature. That said, why are they cyclical? Because they are dependent on interest rates. When interest rates are healthy, I don't want to say when interest rates are up or down, because that gets confusing. I should say if the interest rates are healthy, because some interest is required. You cannot have zero interest. Zero interest is also not good. So when interest rates are healthy, stable interest rates, loans grow, consumers spend money, and things are humming along. Growth is predictable. Predictable growth is good. Whatever it is, 2% to 5% to 10%. Depends on where the scale is. Some developed economies are at 2%, which is great for them. Some developing economies, like in India, could be at 7, 8% and even 10%. Now, the spread is important to understand the context of this. When do they become risky? When economies slow down and loans go bad. Like we're seeing in Indian microfinance sector, and I did a video explaining why that is happening. Some of it to do with the monsoon, some of it to do with poor management of water, led to a lot of pressure in the rural areas of India, and that triggered further pain to the NBFCs. This is nature of the beast. So when economies slow down, loans go bad, and these banks and financial institutions tend to suffer because of this. So what big banks do and modern banks do is they try to mitigate this and balance this by having steady income from traditional sources of banking, and also look at growth potential, digital disruption, and they try to diversify. And that's why banks also, of course, they got caught in the wrong side of trades, and that led to a lot of problem. But that is the main reason why they do those trades, because to balance it. So when loans go bad and all that, they still have another source of revenue to kind of keep things balanced and keep things moving. So this is the basic outline of this whole industry. Now let's look at Japan to start with. There are two big giants in Japan. One is Sumitomo Mitsui Financial Group, or SMFG. Then there's another one called Mitsubishi UFJ Financial Group, MUFG. These are the two largest banking groups in Japan. They offer retail banking, they do corporate lending, and they do investment banking, plus they have global market exposure. So if you look at it, they're a whole karul and they have all of it. So it's like a buffet spread where you get exposure to everything in terms of domestic markets in Japan and international markets in terms of finance with these banks. And being the largest banks, they are very old and they tend to be very conservative in the same tune as Japanese culture is, and the way their philosophy is also very conservative. They don't take very flashy bets, they don't take unnecessary risk, and the management is also very old and they're very slow. So that said, these banks, because the Japanese economy, the whole stock market has been undervalued for a very long time, it's very hard to look at it historical numbers and historical values and understand these numbers and say, oh my god, historically speaking, they're expensive. Because they've been depressed for a very long time, you really cannot focus too much on the historical data for these banks. But more what you should be focusing on is the potential of the Japanese economy and the Japanese people and where these banks are operating and who they are lending to. So these corporate lendings are very important for you to study in. Who are these banks lending to in terms of corporates? Which Japanese corporates, and what are these corporates doing? So are these loans which they're giving, are they secure, are they safe? And also, of course, in terms of global exposure, what they've taken. In terms of retail banking within Japan, that is a big question mark right now because the Japanese economy is going through a transformation right now. Interest rates are going up, inflation is going up, so it is leading to a lot of transformation. It is very fragile, what is happening in Japan. I can't say everything is hunky-dory, it's all going to just go to the moon. So that also you have to take into consideration when you study these two banks. Because when you look in terms of valuations, these banks are very cheap in terms of comparing to their intrinsic value. For example, Sumito, which is trading at 3,587 yen, Japanese yen, its intrinsic value, if you look at it, all the loans and book it has, you can put it around at 6,176 yen. So it is around 42% below intrinsic value. And in the same way, Mitsubishi, if you look at that is a MUFG, that is trading around 1,967 yen. And if you look at it in terms of intrinsic value, it should be around 3,636 yen. So that is also looking around at 46% below intrinsic value. But if you look at it historically, they'll both look very expensive, like I said, because for the last 10 years, if you look at data, even longer, these banks will look very expensive compared to that because the Japanese economy itself is now coming out of slumber. So keep all that in mind, and like I said, when you analyze it, keep whatever I said as part of your analysis to understand who are they lending to, who are these people, what are they doing in terms of business. Understanding all that is very important because that is where the bank's revenue is coming from. This is as far as banking is concerned in what you guys asked for these two companies I've spoken about in Japan. Now let's switch over to US, where we're going to talk about United Health Group, H. They're the biggest insurers in the US. They handle insurance, they run clinics, they manage prescription services. The revenue keeps growing because people need healthcare. It's as simple as that, no matter what the economy is doing. Now, with what Donald Trump has done with Medicaid and the spending cuts, we'll have to understand this and analyze this and the implications to United Health, because all the data we're looking at is, of course, the past data. The current environment in the US has dramatically changed thanks to the One Beautiful Bill. And what is going to be the effects for this United Health Group? Is it a benefit or is it a further risk for the group? Is something that we have to study and deep dive and look into it. You will have people on both sides arguing both ways. So you need to find a middle ground and see what is the future for this. Because a year and a half ago, this was like a no-brainer at the price where it is right now, because it is trading around at $307. And if you look at it in terms of intrinsic value, so if you're looking at it in terms of historical data, a year ago, whatever I said, it's a no-brainer because it's trading around $307. And in terms of intrinsic value, it's well below that, and it's around 40% below its intrinsic value, which will probably be around $600. But even there, this is all based on what it was. Now looking forward, does United Health Group have the ecosystem, what it had, much like what happened to Tesla. What are the implications to this is something that you'll have to understand and deep dive. In the short term, of course, there's a lot of room for it because the way the stock is priced right now, they do feel at least there is an upside of around 18 to 20%. But I also don't know if that 18 to 20% will really be there with everything else taken into consideration. So I would love to know what you guys think about United Health and what I said doesn't make sense, and what are the implications that you think will be from this beautiful bill as far as United Health is concerned. Now let's move to France, where we have Sanofi. This is a major European pharmaceutical company, and they make money through vaccines, plus they have a huge pipeline for chronic diseases like diabetes. And a lot of you have been asking me about this because the one in India, the Indian subsidiary, is currently overvalued extremely, around 50%, because most of these companies, multinationals which are operating as subsidiaries and listed in Indian markets, are very extremely overvalued, and the parent companies are much cheaper. Is this the case with Sanofi? Yes, it is, because like Nestle, in India it's overvalued by 50%. Hindustan Unilever overvalued in India by 50%. But in their home countries, in their home markets, Unilever is very cheap. Of course, Nestle is, I think, is relatively cheap compared to India in Europe. Same way Sanofi in France, if you look at, it's currently trading around at 83 euros. And if you take a baseline intrinsic value, it comes around to 88 euros. And if you take the best circumstances, it's at 130 euros. So anywhere between 2% to 36% it's undervalued. But that said, the French economy, if you look at, and the European economy you look at, there is a lot of pain. And if you look at putting that all into perspective, European companies are going to be in a lot of pain. If you look at the GDP and debt ratio for France, it's almost where UK is. So both these countries are really struggling, and that too with the war in Ukraine going on and the hostility towards Europe as a whole from Donald Trump with the tariffs, there is a lot of pain. So we may see further corrections, and that is a funny thing right now in the market, which I wanted to come to before I get into Nasdaq. If you see what Trump is doing, first the market has shock. Now it's become so desensitized that yesterday when he announced massive tariffs on tariffs, the market didn't even bother. It didn't even flinch. It kind of shrugged and moved on. So I don't know if this will be another taco Trump move where he chickens out finally and he steps back, because it was supposed to be 9th July and he kicked it to 1st August. Now he said, no matter what, there's no more postponement of the deadline. So I really don't know. So we'll have to wait and watch to see what happens. But the market seems to think he won't really do anything. And at the end of the day, he'll come back to the negotiation table and keep extending these tariffs. So they don't seem to be rattled by it. So keep that in mind. We might find volatility coming up, and if volatility comes up, you may see short-term pain if you enter it early, and then you see your 83 euros slide down and before it slides back up. So do you wait or not is something you'll have to consider in mind. Keep in mind, and also keep another thing in mind. Do not enter any of these markets, be it a European market, American market, or Indian market, in huge, vast sums right now, taking huge positions, because there is volatility expected. Everyone is saying it. So other than Donald Trump, everyone feels this is a weird place we are living in. We're living in the twilight zone. So keep that in mind. So take investments low, keep it simple, keep it steady, and like we do Tiffin Coffee range in India, you can find some methodology of keeping your investments in a level where you don't lose your mind if you suddenly see your 83 euros become 60 euros. Keep that in mind. So moving into the last thing which you guys asked me about is sipping, and that too in the Nasdaq 100 ETFs, because like we said yesterday, the big tech companies are all overvalued and they're very expensive. So is it better to take an exposure into these big tech companies through the Nasdaq, through the QQQ, which is one of the biggest Nasdaq 100 ETFs, because you want some exposure to tech? No, because what does Nasdaq mainly consist of? It's mainly weighted on Apple, Nvidia, Meta, Microsoft, Amazon, Google, Tesla, Costco, and all of those companies are extremely expensive right now. So that push in logical sense that makes Nasdaq 100 very expensive right now. So even if you are investing in terms of sipping in it, in the long term, for example, the last 10 years, Nasdaq has given 10% return. Last 2 years, it's given 52% return. And the last 10 years, it's given 48% return. So in the last 10 years, the CAGR of Nasdaq is 4%. While at the same time, if looking at it 5 years, it goes up to 8%. So if you see the growth, whatever you have seen, it's very short term. So that means the price has moved up and swung to an extreme. The pendulum has gone to an extreme on one side. So right now, it's not the time to step into a Nasdaq 100 ETF. If you are interested in sipping, I would suggest staying in the S&P 500 because that is a much broader index and it's much safer and it's more defensive to be there than to be in the Nasdaq 100 would be my opinion. And you can keep sipping there, and that too also keep it simple, keep it small and keep plugging away at that because that is far safer right now in this current environment because even the S&P 500 is in an all-time record high. So like I said, if you really are interested in investing and you have some lump sum, look at short-term T-bills and sit on it till we see some reason to enter because the greed index in the US is through the roof. We are almost past 80% I think in terms of greed. Instead of being in the middle or being in fear, where that is a point when we would love to enter as value investors, we are at a position right now where it's a wait and watch game. So this would be my sincere advice to you, to take this strategy or at least consider what I'm saying. And like I said, this Q&A questions which I've compiled from all videos so far, I'll take it up at the end of the week and I'll cover all your answers to your questions at the end of it. So keep dropping your comments and questions to these videos, and I promise Saturday and Sunday to do a long video where I sit and talk about each of your questions in great depth, and maybe try, if Anand is free, to bring him in and ask him your questions and get his views also on this. So tomorrow we'll get into day 4, which will be cybersecurity, cloud and digital infrastructure, the backbone of this so-called modern economy which we are running. That will be interesting, and I'll talk about companies there. Other than that, nothing else. Have a wonderful day, have a wonderful evening, whichever part of the world you're watching from. Nothing else more to say. Stay patient, stay invested as always, and see you tomorrow. Thank you.